A closely watched government measure of inflation is expected this week, turning the attention back on the Fed's potential and their next move with interest rates. Yahoo Finance spoke with New York Fed President John Williams earlier today on what it will take for rates to come down, and this is what he had to share.
So if you look at the projections in the economic projections that we put out in March, we all, or at least the median dot, has the funds rate going down in next year and the year after. And I think that's really primarily driven by the fact that inflation is coming down and we'll be moving monetary policy to a more normal stance. So I think that's an important driver of inflation, of interest rates eventually coming down. Obviously, other factors, how the economy is doing and how this all fits together, would be relevant as well.
Joining us now for more on the state of the U.S. economy and the road ahead for the Fed, we have Jennifer Lee, BMO Capital Markets Senior Economist. Jennifer, always a pleasure to get some of your time and insights here. In some of your notes, you've said that there's one more rate hike to come and not expecting rate cuts until 2024. Set some of the thesis around that for us and what you anticipate the Fed will do with the data that they've ingested thus far, plus some additive to come in the weeks before their next meeting.
I think first of all, good morning, and thank you for having me on again. They've already hinted quite strongly that there's probably just one more rate hike on the horizon, but of course, everything is always data dependent, and they will probably be deciding on a meeting by meeting basis. But at the same time, as your previous guests have been talking about, as the New York Fed president has been saying, inflation remains far too high. And why would they start cutting rates so quickly? So I think at the earliest, we could see a rate cut would be coming in probably in late 2023 at the earliest. But our base case scenario remains 2024 before we start seeing the funds rate start coming down.
So what does then growth look like if we do get a sort of holding pattern from the Fed at the same time that, I guess what I'm asking is, do you expect financial conditions to continue to tighten even if the Fed itself is not continuing to tighten? And then what economic effect will that have?
So financial conditions have already started to tighten a little bit, thanks to this, banking crisis that we saw. I guess it's been just about a month ago now. But at the same time, with 475 basis points of rate hikes already in the bag, or at least, already in the bag, that is starting to have an effect, obviously. We won't feel the full effect for probably another few more months at least, but we're probably starting to see that recession coming into play. We had a very strong start to the year, thanks to weather. Warmer weather helped, of course. So we saw super strong numbers for January. There's a lot of expectation that February was going to pull all the way back, but that didn't happen. We saw some retracement, but not a full retracement. So that actually set the stage for a pretty solid start to the year. But so far, the March data have been a little more on the wobbly side. So I think this is sort of the beginning of when things start to slow. We've been penciling in 2 consecutive quarters of negative GDP growth for Q2 and Q3. We've actually, frankly, been pushing out that start of the recession thanks to overall resilience of the U.S. economy. But we do look for 2 consecutive quarters of negative growth in Q2 and Q3 before things start to pick up in the final quarter of the year.
Jennifer, even in the areas that are starting to show some slowing, what, in terms of the trend that the Fed is looking for, how long do you believe that trend is on a month-to-month basis that they're going to be monitoring for to say, okay, now it's time for us to pause, or now it's time to us to even start to talk about what cutting may look like in the future and what the economic impacts of that might look like?
So for any particular, data point, you can't just look at, and then, obviously you can't look at just 1 month because 1 month does not make a trend. But at the same time, it's all going to be, they're going to be focusing on the trend itself. And of course, ultimately it all comes down to inflation, which again remains far too high. And this is why, as you've been saying, everyone's waiting on pins and needles, very much so for tomorrow's inflation report. But of course, at the end of the day, it's not going to be riding on just that one inflation report. It's interesting, I think nowadays is how, back in the old days, we will only be looking at headline inflation and then core. But now, you're breaking it down further between there's headline, core, and then you break it down between goods and services. And goods, we're finally seeing that disinflation that the Fed chair talked about a couple of meetings ago. The services inflation remains far too high. And then within services, now we're breaking down between that into that super core component, which excludes all those other different various components, which I'm getting very confused about because there's too many components out there to focus on. But it seems like they're drilling it into lower or deeper and deeper into components to make sure that they are very comfortable with the fact that inflation is getting down to that point where they will be able to comfortably, again, signal a pause and then eventually start cutting rates next year.
Jen, I'm glad I'm not the only one who is confused by all of the components of inflation. Speaking of inflation forecast, the IMF is out with its new global growth forecast this morning. For inflation specifically, it says it's going to go from 8.7% in 2022. It's going to fall to 7% in 2023. That's globally, right? That's not just in the U.S., but that's not like it's great news here. How sustained are we going to see, a rise in inflation? Is this going to be a years-long situation where we can just expect inflation where once we didn't really have any?
Right. Of course, every country is going to be different, but globally, inflation will remain high because, we still have a lot of upward pressure, for example, on global food prices. And that could be still ongoing impact from, the war. And of course, Mother Nature has a big say in all this as well. So we've got a lot of, so food prices still remain very high. So that's probably one of the big factors supporting global inflation. But every country has its own issues right now. The U.S., again, is still far too high. Canada's actually been coming down quickly. So we're just over 5%. The UK, doubled their inflation rate is still twice the level here in Canada at 10.4%. So they still have their, again, they're still working on the headline itself. In the euro area, we saw a big decline in headline CPI, but that's due to base effects. Core CPI remains at a record high. So again, every country, and then we saw CPI numbers coming out of China this morning, and that's coming down because of weaker demand. So every country, different circumstances, which is why all these different central banks are sort of approaching it with different types of gloves on.
Yeah, most definitely. So just to focus on here in the U.S. for a sec then, if we're coming down this year, when do we actually get back down to the Fed's target of 2%? And then does it just stay there?
I don't think it's going to stay there, but it's always going to be volatile and hovering around the 2% mark. But we do have it coming down to 2% by the end of 2024, just over 2%, and that's again due to aggressive Fed tightening and the appropriate response from the economy, which is slowing demand, and at some point a labor market that's a little bit more balanced than it is right now.
All right, we'll see what happens. Jennifer Lee, BMO Capital Markets Senior Economist. Thanks so much. Good to catch up with you.